We'll start off with introductions.
Okay.
Tell everyone about yourself.
Sure. Hi, I'm Andrea Roschke. I'm a CPA. I've been in practice, I hate to say this number, but over 40 years, and I help individuals and businesses grow and do strategic planning and try to pay less in tax.
That's a good one.
Yeah.
My name's Kyle Crown, and I'm the president of Los Angeles Property Management Group. Before I did this, I was an investments analyst for KTR Capital Partners years ago. It's been almost a decade here for me. And before that, grew up in Thousand Oaks, California, Thousand Oaks High School, and went to the Wharton School of Business at the University of Pennsylvania. Lived in Philly for a good few years there. Today we'll have a conversation about some tax accounting topics, and specifically for rental property owners, hopefully within or around the city of LA. What's one thing you typically lead off with when you speak with maybe a client who owns rental property?
Well, we talk about keeping good records. I think that's probably the most common mistake either business owners or rental property owners make, is they don't keep track of their income and expenses. And when you file your tax return, you need all of that information to be accumulated in a certain manner. So I think that's my first advice, is make sure that you keep good records of your income and expenses.
Yeah, makes sense. Are there any specific record keeping or accounting software systems that most of your clients use, or that you maybe would advise anyone not to endorse anything specifically?
Right.
But I'm just curious.
Well, I mean, for rental properties, you can keep a simple spreadsheet. You don't have to get fancy. I like for personal finances and rentals, those types of things, I like Quicken, and most, probably 95% of our business clients use QBO, QuickBooks Online, so that,
Like we do.
Like you do. So it's, there are tools out there to make it easy. But in a rental, unless you have, hundreds of rentals, a rental property, you could probably just keep a simple spreadsheet.
Yeah, and we have a lot of clients who come to us, and before moving to professional property management, which we use, Appfolio, and
right.
Like you said, if you manage hundreds of properties,
yeah.
that's a solution. But if you manage one or two, or you own just a few rental properties, a lot of our clients come to us and having used QuickBooks,
yeah.
or QuickBooks Online before.
And that would be my other recommendation, to talk to a property manager, because they know how to keep track of the expenses for you.
That is what we do.
Yeah.
Certainly true. And that reminds me, before we started talking about this, I had mentioned we've been working with your team at Roschke Wall for almost 3 years now.
Yeah.
Just wanted to give us a quick shout out to you and Abby and the whole team.
Yeah.
It's just been such an awesome experience, quite honestly, given just where we were before and where we are now.
That's good. That's what we strive for. Should we talk about how we know each other and how long?
I was going to throw that in there too. It's a trusted CPA for 3 years with us, but a family friend for decades.
I actually went to high school with your mom, and we were college roommates, and then your dad also was in college with us. So I've known you even before you were born.
That is wild.
So it is wild to be doing business with people that are my friends' children. But yeah, I'm really proud of how you've grown this business and what I've seen since we started working together. So I'm glad to get to know you in a professional manner too.
I'm sure when I was 1 or 2 years old, you were thinking, I'm going to be sending a lot of emails.
That's right. That's my
forward.
Future client right there. Not.
It's been years, and honestly, we probably should have moved over sooner. And just grateful for everything that you and Abby have done to keep it all moving forward.
Great.
A lot of our clients recently have shown interest in cost segregation studies, mm-hmm. and just depreciation generally. I know that's probably a question you get a lot mm-hmm. from real estate owners, but is there anything specific to either or both cost segregation or depreciation that you'd mention or throw out there for owners of real estate?
Yeah, so and for those people who don't know what cost segregation is, when you buy a property, you have a building and you have land, and the building portion is the only portion that gets depreciated. And for residential real estate, you depreciate it, which means you write it off over 27 and a half years. What cost segregation analysis does is it takes the components of the building and breaks it out into segments. So it takes the cost and breaks it into segments, and some of those segments may allow for faster depreciation. So you can, instead of 27 and a half years, you can have 5 years or 10 years or 15 years. So it's really worth the investment to talk to a cost segregation specialist, and they'll prepare a report, and that is what the accountant uses to depreciate the property, and you get some acceleration on that write-off.
I remember looking into that for a property that we had a few years ago, and it was a lot of work.
It is,
certainly.
yeah.
But I remember.
But there are companies that specialize in that, and we partner with them, and it's really been worthwhile for a lot of our clients, and even more so with commercial properties. But
Okay.
a couple have done it for residential as well.
Yeah, and I feel like that's something that a lot of people don't know about. I honestly didn't know about it before we went through that process, and it was useful, beneficial,
Yeah.
worth discussing and looking into. So
Yeah.
thanks for the background on that.
Mm-hmm.
Another question that I'm sure you get a ton of, and we get a lot managing property, but 1031 exchanges.
Right.
Can you just quickly define a 1031 exchange for our viewers and talk a little bit about how property owners can take advantage of that?
Right. So when you own an investment property, a real estate investment or any other type of investment, when you sell it, you're going to potentially be subject to capital gains. So and it's basically a simple math. How much did you pay for the property? What costs have you and improvements you've put into the property over the years you've owned it, minus what you sold it for, and that's called a capital gain. You pay tax on it, and that's the simplest way to dispose of a property. But if you've held a property a long time, you have a huge gain, and you're interested in staying in that investment field, you can do what's called a deferred exchange, or a 1031 exchange, also called sometimes a like-kind exchange. And you need to use a professional intermediary, because the money can never get into your hands, or it's deemed to be a realized gain. But what you do is you basically put your property into this exchange. You have to identify another property that's like kind. So you can't take a apartment building and trade it for a residential home. And you can't do this on your personal residence, by the way. I always want to point that out, because people call me and say, oh, I'm just gonna do a 1031 exchange, but it's my house. No, you can't. So, and as long as you invest in something that's higher than what you're giving up, you can take the gain and roll it over into the next property. So you don't pay tax until you ultimately sell the final property, but you can roll things over again and again and just keep pushing that gain further out into the future. The tax on that gain.
Yeah. No, I mean, it's hugely advantageous if you can figure out how to engineer it just right. And I know we've had clients do that in a few different capacities.
Right. And you can even take up property and buy 2 different properties, as long as the value is higher. So you don't have to say 1 for 1.
That's really interesting and unique too, though. I think a lot of people don't realize that.
Right.
It makes sense. It's a complicated move, but one that's worth studying and working with professionals too.
Right, because there's the intermediary, and then there's specialized reporting on the tax return. So you need to make sure you're with a tax person that understands how that gets reported.
I would assume you guys do.
We do. Done a few.
So there's definitely a lot of confusion out there between expenses and capital expenditures. I get questions all the time from our clients, or preferences from clients who want certain things classified or categorized a certain way.
Right.
Is there anything you would say about just CapEx and generally how you approach that with clients?
Sure. Yeah. The IRS actually came out with some repair regulations. I think it was in the Tax Act of 17. Where they really further define that, because that's a huge issue for renters and rental owners and So you basically have to think about what is the substance of this expense. Are you improving the property? Are you extending the useful life of the property, or are you making a repair to something? So the simplest example I can give is, did you repair a hole in the roof, or did you put a whole new roof on? So you have to be really careful when you're recording those types of expenses to make sure that you're not putting something as a repair that belongs as an improvement, because the improvements have to be depreciated over the life, and most of the time it's the same life as the building. But again, we can analyze further what the improvements are to get faster depreciation. So the other thing that came out during that the repair regulations was that there's a safe harbor now, which is a good thing. Anything under $2,500, the IRS says, I don't care, just put it in expense. So that's nice, because if you're I bought a new water heater, it's $1,500. Do I have to capitalize it? You could just say, well, it's under the safe harbor. So, and we make an election on the tax return every year saying we're making that safe harbor election just to protect our clients. There are things that sometimes get in the gray area. We redid the whole plumbing system. Did we replace the plumbing system, or did we repair the plumbing system? So those are, you have to really dig into the details. So keep those kinds of invoices from your contractors. The better tax write-off is to expense it, right? So everyone wants to do that. But if I'm looking at your expenses for the year and I say, oh, you have $72,000 of repairs, I'm going to ask you for a little more detail for that. So, and that's an area, because of the regulations, the IRS will be focused on if they do audit you. So you want to make sure you're prepared for that.
Well, it's nice to have that safe harbor dollar amount.
Yeah.
Before that, I remember getting a lot of questions from clients, and some clients were more conservative about it, and they'd say, hey, anything under 1,000, let's go ahead and expense it, but let's not get too high with that. And so now, just to know, hey, $2,500, that's really a good cut.
Yeah, it's not even worth talking about. So I like that safe harbor also.
I will remember to tell clients that more often.
Yeah. And I've taken over tax returns from other accountants, and on their depreciation schedule, there's all kinds of little things like a $200 faucet, or and it's like the paperwork that goes into depreciating that when you could have just written it off.
That makes sense.
Unfortunate.
Well, and that leads well into, I think, our next question, which we get equally as much from clients, but just about any deductions, general write-offs or deductions that you would recommend to anyone who owns rental property.
Sure. So there's the obvious ones are, anything related to the property, the property taxes, the mortgage interest, gardening, utilities, repairs, as we mentioned, property management fees. So if they're paying you to manage the property, that would be deductible. The things that people often miss, I would say, if you go back and forth to your rental property, you can deduct some mileage for that. So you should keep track of the number of times you have to go out there and visit your property, and if it's in another state, if you have to fly there. Travel expenses are deductible in hotels to do some repairs. I mean, if your properties in Hawaii and you spend a week there, and you're clearly not doing a week's worth of repairs on the property, but maybe a day of the trip can be deducted. And then what do people miss? Homeowners association fees. For some reason, people forget about those, so I usually have to remind them, and homeowners insurance.
Oh, okay.
The other kind of more obscure things may be a portion of your cell phone bill, a portion of your home internet. So anything that you're using as a tool to help you manage the property, we could take a portion of that. Maybe not the whole thing, but you maybe spend 25% of your time on property management business. So you can take 25% of your cell phone, of your internet, and things like that.
That's really good. Some of those things I want to remind clients of, because we have clients who drive to their properties all the time,
right,
and probably are not writing off
the miles.
Yeah, exactly. So I've heard a little bit about passive losses, but I don't know very much about what they are. Can you explain for anyone watching a little bit about them?
Sure. So the government doesn't allow a taxpayer to deduct what's called a passive loss unless they have passive income. So if you think about what creates passive versus active, is your job and your W-2 income is active, your rental property or your interest income may be passive income. So if you have a loss, if you generate a loss from your rental property, which most people will after they depreciate it, you may not be able to deduct the whole thing all in 1 year. So on the tax return, you're limited to passive losses first, offset passive income, and anything that's over that may be limited. It just kind of depends also on your other income. So at 150,000 or higher, you're not able to deduct a passive loss at all. If you're active in your real estate, so that's another one of those rules. And by active, I think the number's 500 hours a year. They consider you to be actively, and most, that's not I might have that number wrong, so we should probably fact check me. But then you can deduct up to $25,000 of passive loss in a given year if your income's under 100,000. So it's kind of it's the passive loss rules. If you look those up, you'll see that there's limitations. And again, your accountant should know this. And just don't. If you do have a year where you have a lot of expenses, you may be disappointed come tax time because you're not able to use them that year. They do carry forward, so the next year you could potentially use them. And if you sell the property and have an accumulation of those, at that point you can deduct the whole thing once you dispose of the property.
So do you need multiple income streams to be able to write off passive losses then?
You need passive so if you have two rental properties, for example, you have a passive one that has a profit and one has a loss, you can offset those against each other. But if you have one passive activity, like just one rental with a loss, your loss may be limited. The other passive types of income, I said interest, but that's really like investment income. But it'd be if you would be investing in a partnership. And so the partnership has a loss, it's considered a passive loss. So again, passive loss rules are kind of complicated, but you should be with a professional who understands those.
Worth speaking with your tax preparation professional about that, certainly.
And that way, when you're putting your taxes together, you understand why maybe you spent all the money, but you don't get deducted all in 1 year. I hate when that happens.
But potentially in future years.
Yes, it's accumulated and carried over. So.
That's really interesting. I did not know about that, and I'm glad I do now. Thank you for coming in and sharing all this with us. This is really awesome.